Smart investors follow the stock market. But who does the stock market follow?
Joining us now from Philadelphia to discuss the impact of the Fed's inflation fight on stocks, Jeremy Siegel, professor of finance at Wharton.
Jeremy Siegel, one of the world's great market historians from the Wharton School.
One market watcher who warned of sky-high tech valuations all year, Wharton professor Jeremy Siegel, and he joins us now.
You warned that valuations could not last. You even predicted a decline, much like we've seen the past year or so.
I would be very careful about these PEG ratios. Let me tell you why. The NASDAQ has nearly doubled in 5 months. One of the things that I did in my article...
I don't know whether you read Jeremy's article in the Journal. Don't admit it if you don't. I did, but a couple days ago, it was right on the money.
Jeremy Siegel, professor of finance at the University of Pennsylvania's Wharton Business School, is right on the money. Whether the market is trending up or trending down, when Professor Siegel speaks, Wall Street listens and investors learn.
You know one of the fundamental features of our new economy is going to be? It's going to be a more competitive economy. With the information flowing faster and easier, margins are going to be cut. Value depends on margin. It doesn't depend on sales. Internets are finally discovering that. I mean, you know, they thought sales was all that mattered. Clicks are all that matter. You know, we get the customers. It doesn't matter how much you pay for the customer. They're paying $20,000 to get a customer that was buying $30 a year off their internet sites. I mean, what sense does that make? They had no concept. It is margin that produces value. Margin, not sales. If it were sales, the most valuable corporation in the world today would be General Motors. Well, actually, I think that just last year, Walmart for the first time crossed General Motors in total worldwide sales, but they're close. General Motors is down where in market cap rank? 10th, 100th? It's not on any lists of top rank. It has huge sales. It has thin margin. Sales do not translate into stock value. You need margin. In a competitive world, as our future is going to be, margin is going to be tough, very tough to come by. You know, it came home so much to me, you know, I wanted a couple things at Staples just a few months ago. So I just went to the internet and looked up the items under one of these, you know, price comparison systems and found out who was the lowest. Staples wasn't the lowest, but Staples was near me. So I just printed out those pages, brought in the Staples. Oh yeah, we'll match you on all those prices. Where is the margin? I mean, they were committed. Oh yeah, we'll match you on every one of these prices. $10 lower here, $20 lower here, $10 lower there. Wow.
Wow was the reaction to the publication of Professor Siegel's book, Stocks for the Long Run. Often referred to as the Bible of the bull market, this meticulously researched bestseller catapulted the unassuming professor to the position of financial oracle.
One thing amuses me. How many of you remember last March, February and January, when Greenspan was raising rates and tech investors said, we don't care about that. We don't care about that. We're all equity firms. We don't borrow anyways, you know. And we're not worried about that. I mean, tech investing is got to be the most important thing. It's the last thing that's going to be cut. You know, higher rates, ridiculous. That shouldn't stop anyone from investing in tech. Hasn't the tune changed a little bit now? Now it is, please, Alan, lower the rates for us. We really need those lower rates, don't we? I mean, it is interesting that on the day that Greenspan lowered those rates 50 basis points on January 3rd, it was the biggest one-day gain in history for the NASDAQ, the very index that snubbed its nose at Greenspan raising rates.
Raising eyebrows is what Jeremy Siegel's published opinions and articles have been doing since the late 90s, when he cautioned that internet stocks were overvalued. That very day, they plummeted.
You talked about a month ago about overpriced internet stocks, and in fact, the market fell on your op-ed piece in the Wall Street Journal. They still have further to go, you think, or they've come down enough?
I got an awful lot of angry emails from AOL owners on that day in April. I think there's some more correction downward that has to come to these stocks. I mean, still the big names are still 200-300 times earnings, and even though they have great promise, that's really unprecedented when you take a look at history.
When he warned against inflated big-cap tech stocks, again, the market dropped. No wonder he is called the Prophet of Profit. An impressive title, especially from a student perspective. Add the Business Week Best Professor Award to all of that, and coming to class is more than worth it.
I remember one particular morning where Professor Siegel spent the 9 to 9:30 half hour telling us what he thought the market was going to do. And as the markets opened, they literally did exactly what he had said.
I look at what's going on in Europe and what's going on in the early morning markets, and I say, well, the Dow is going to be up 50 points in the first 20 minutes.
8 Dow, 10.
And I'm often right.
The biggest failing that most analysts do when they do this type of analysis is they look at today's price of the stock and compare it with earnings 2-3 years down the road. But that doesn't work, because that assumes that the price is going to be unchanged for 2 or 3 years. The only way that tech investors get return is by appreciation. They're not going to hold this stock if they think the price isn't going to go up. They're going to either expect a modest 10% appreciation, which is on the lower side, or a little bit more aggressive, 15%. You've got to build price increases in there.
The 200-year look at stocks, bonds, treasury bills, gold, and the value of the dollar, the persistence of the stock returns is a very important feature. And by the way, when I do make client presentations, it is very, very useful to show them this slide, because those wiggles in that stock line are the great bull and bear markets over time, which of course so upset investors, but really which pale in significance compared to the upward thrust of stock values. So this is a comforting slide for them in terms of thinking about the long run. And it's interesting because as the data is updated now, the after inflation real return on bonds is 3.5% a year. It's exactly 1/2 of stocks. So now this really sticks into the minds of investors and clients. You get 7 after inflation in stocks, and you get 3.5 after inflation in bonds. Although the bond return, as I've often emphasized, is nowhere near as stable as the stock return over long periods of time.
Professor Jeremy Siegel is in demand. The media, major investing firms, national and international corporations, even government leaders want to know what he thinks the market will do next. And Professor Jeremy Siegel is always right on the money.
Bubbles result when new technology discoveries capture the public imagination. Early developments outpace forecasts. Stocks begin to rise, emboldens the supporters of it, frustrates the doubters of it. Short sellers often lose money selling bubbles. That's the fascinating thing. You know, you say, oh God, if you recognize it's a bubble, isn't that an easy way to make money? No. It's one of the most frustrating things in the world, because unless you get it just at the point that it tops, you are going to be losing and losing big. And a lot of people did. A lot of people shorted the internet stocks in the early stage. They kept on going out. They were forced to cover. They dropped out. That leads to even more price increases, and then the momentum. Investors pile on after that. And as I mentioned to you yesterday, it's still my belief, you know, it's a lot of, I see the media and even some investors are, yeah, we're frustrated with the analysts. I don't know how many of you watch CNBC today. You know, analyst XYZ has just downgraded this stock, this internet stock. It's fallen 95%, and now he downgrades it from buy to what, accumulate or hold or something like that. I mean, now where have you been? I mean, well, yeah, now you tell me. And they're really, it's interesting to watch these guys and see them. They're really poking fun. Oh, here's another one. Oh, yeah, all right. You know, they come out with a bad earnings news. The market, you know, the stock tanks 70%. They downgraded it the day later. Thanks.
good news about bubbles is once they pop, there isn't another one that forms for about 15 or 20 years or even more. I mean, the painful memory of what has happened keeps investors from running after those stocks. So that's the good news we could definitely look forward to.
Well, thank you very much for your attention. Thank you. Thank you.
For more information on how you can get Professor Jeremy Siegel to speak at your next event, contact the provider of this video.